This conference will now be recorded.
All right. Good morning, everybody. This is Greg Morton. It is Monday, December 26, 2022. Markets are closed. And of course, Merry Christmas as well as Happy New Year to everybody. This is the weekend video update for the Greenville Eastside IBD Meetup Group as well as the Stockyard Meetup Group. So, as always, this weekend reviews for educational purposes only, not recommending stocks or securities to buy or sell. All investing has substantial risk of big losses, so we want to make sure we learn first and only then invest. Topics for today, we're going to look at the M factor, very important now. Current market review, what do we see? Constructive action or destructive action, accumulation or distribution, stock setting up or a chop fest. And if you've been following the market, you know the answer to those questions. Talk about current action plan, as well as our next meeting on January 18th, 2023. So we'll look at the M factor first. As O'Neill teaches us, this is the most important letter in Canslim. 50% of being successful is being right on the M. And if you're not right on the M, you're going to have a lot of struggles. So O'Neill IBD teaches us to diagnose. We don't want to interpret. We want to interpret. We don't want to predict. And we want to look at three things in this order of priority. One, the action of leading stocks. What leaders? We just have a few that are sort of struggling to stay on Survivor Island. Actions of stocks owned. So there's only one baby size long position left in the group teaching portfolio. Otherwise, it's just cash and then a short position. And then market pulse, distribution day count, price and volume on the indexes, all of which I sort of encapsulate in the coloring book. And there's just lots of Rudolph nose red across the board right now. So let's take a look at that. Let's start with the index charts. So let's go up here to indexes, NASDAQ. So here's the daily chart. Can just see we've been in this sideways chop fest. We're back to over 35% off. We're still in a real bear market, still got serious downtrends on the 50-day and the 200-day moving average lines. The NASDAQ has lost all four moving average lines. Anytime it's gotten close to the 200 back here, and even that's not very close, but trying to get close, it's just gotten slapped back down. And we're coming close to undercutting these lows back here, which will officially kill the rally. Our follow through day was back here, which is already closed below it, so that's a bad sign anyway. And now we're closing below it again. So that's where we are on the NASDAQ daily. The S&P 500 is going to look similar. It's lost all four moving average lines. The 10 and the 21 haven't crossed over the 50 yet, but it's just not looking very positive. It's not as far off. 20% red lines right there. Just draw that over. So it's between 20 and 25% off still, but still an ugly bear market. And let's look at the weeklies real quick on those two. So the NASDAQ's probably most telling. So we clearly can see three legs down. Most bear markets have at least three legs down. They can have more. We've started a potential fourth leg. No way to predict. I just kind of drew the line showing that. If we come down and undercut, obviously we'll have a fourth leg down, maybe come down below 10,000. Who knows? You can go to support all the way over here at 98.38. Maybe it comes down to that. There's just no way to predict, but we're pretty far in, 13 months. So we're sort of past the average, year and a half. I guess we're in the median range for typical bear markets. Our peak was way back here on November 22nd of 2021. S&P 500 looks very similar. There's your three legs, potentially starting a fourth leg down. And of course, when the 2000 bear market ended in March of 2003, this last leg, which was more than the fourth leg, actually didn't come down and undercut. It just came back down and tested. So no way to predict what happens from here. Just know it's not a good environment looking at the index charts. Daily on the NYSE, back below 3 of the 4 moving average lines, still holding the 50, and the 50's in an uptrend, so that one's showing more strength. Dow, sort of the same thing, still holding the 50 and the 200, so it's showing the most strength, and of course that's just 30 stocks in a price-weighted index. Small caps looking bad, back below all the moving average lines, still just above 30% off. S&P 600, similar, back below all 4 moving average lines. So that's not very constructive. To see it even clearer, we can look at the coloring book, just starting on the left. We only have 6 buying days and 11 selling days in the last 25-day trading window, going back to the orange dot. So that is not constructive. It tells us that it's more of a distribution dominant tape than an accumulation dominant tape. All the MMTS across 6 indexes are red, and a lot of them, they kind of violently went to red, just skipped yellow, massive plunges. So that's showing us how volatile and um, whipsawy this action's been. We have a high distribution day count, medium high, 4 on the NASDAQ, 5 on the S&P 500, and 5 on the Dow. And if we get another one Monday, I think we'll have at least clustering, which is 4 in an 8-day trading window. I'm sorry, on Tuesday. If we get another one, today's Monday and the market's closed. So those are sort of piling up. So that's not good. IBD is the only thing hanging in there at canary yellow, but market school exposure is back at 0%. Also, the window of opportunity is closed, and then on both the NASDAQ and the S&P 500, new lows are exceeding new highs. So that's just a lot of red flags, a lot of very negative signals. This week was just a whipsaw week. Things were up on Tuesday, just didn't make much progress, or I guess that was Wednesday. Indexes were up with volume down, then get slammed again on Thursday, and low volume bounce on Friday. Just volatile, low volume days. Lower volatility during the holidays always lower volume brings increased volatility. So just really, really difficult environment still. Fed's still very hawkish. Powell, as well as the talking heads on inflation. The 2018 bear market and the fall of 2018 was brought about by the Fed starting to talk about cutting interest rates and making changes. The markets reacted very negatively. We sort of had a Christmas Eve massacre that year, which was the capitulation low. Powell backed off of that, became more supportive, and the markets went up. We have the exact opposite now. Powell and the Fed is not being supportive. So that just adds to the difficulty of this environment. So just not anything, Canslim's supposed to push us out of bad markets and pull us into good markets, and doing a lot of pushing and really not any pulling when we look at this. And then the group teaching portfolio, anything on the long side, keep getting pushed out. We only have a partial position in CPRX. Dexcom, that's just a placeholder. There's nothing owned. And then the short positions, the puts and Fry battery, are actually working well, which telling us the market is weak also. Still down 11.5% for the year. We only have 4 trading days left, so not going to end up even a break-even year. So that's not constructive either. So we looked at all of that. So we look at individual stocks. We're still in a bear malls all environment. We'll look at charts. A couple months ago, we were looking at Wolf, Shockwave, on Semiconductor. These were looking like potential future leaders, and they've just been slammed off the horses. Charts are broken. So let's go to Market Smith. We're going to see, the few on Survivor Island. Maybe these will be the leaders when the new uptrend starts. So let's hop over to weekend update. So here's those 3 I was mentioning. There's Wolfspeed, back here. It's looking like it was going to do something constructive, maybe break out of this box area. It's just plunged under the 200-day, under all 4 moving average lines. It's just broken. May come back in the future, but it's going to have to set up. Shockwave Medical, same thing. all the way back down under the 200-day moving average line, set up a base up here, tried to break out, didn't even hold it for 1 day, boom, failed. Fantastic, triple digit earnings and sales. The bear market's just sitting on these things, or crushing them actually. Own semiconductor, same thing, set up a base, looked like it was going to break out back here, get it in November, bam, back down to the 200-day. And then the big monsters, Tesla just getting killed. Look at a weekly chart. So this thing is 70.8% off the high. I mean, who would have thought? O'Neill teaches us that the true market leaders, which it was, look at that big uptrend, come off on average 72%. Tesla's right there. Microsoft, same thing, can't get above the 200-day, bounces up to it, gets slapped back down. Google, just these are the giants in the forest. They're just chopped down. Apple, who would have thought? Supply chain issues. I know we finally had to replace older iPhones, and I was looking at Black Friday sales, and there was a month delay to get one of the new models through Verizon. So it's like the Pro Max. And so had to wait on those. They just came in. And then a couple, I would mention names these are the ones that are on Survivor Island still, maybe holding up. So here's Pod, nice little flat base, only 11% deep, making money. Canslim numbers, was written up in the IBD stock analysis feature recently, so you can read about it. It's cousin stock, Dexcom, not quite as well chart wise, but set up in this, had a little flat base here. So RS lines trying to get to a new high. So these are just, not necessarily actionable names to watch. MedPace, third medical stock, what sectors are working, keep that in mind. Again, a little consolidation. So that's 16% deep. I consider that a flat base. The algorithm, it has to be 15% or less, but that's still nice, tight, flat trading. So keep an eye on that one. CPRX tried to go, pull back down, shook some people out. We'll see what happens. Beautiful RS line on that one. Again, earnings and sales. I'm not even looking at stocks that aren't making money now. I mean, the ones that are can't do anything, and those are the ones Bill teaches us to focus on anyway. Here's TAN. So this is an ETF, maybe setting up. This trades like a growth stock, has the big solars in it, so maybe avoid a little bit of single stock problems if the market can improve. And then just again to show how bad things are, here's ARC. So this thing is back, has crashed below the COVID lows. Just brutal. I think it's 80 something percent. So put my notes over here, 80.1%. So, below even the 72%. So this just shows why you have to have sell rules. What's the monthly look like? Ugh. Black diamond ski slope. Really, really ugly. I mean, it's setting 5-year lows. Wow. So that just shows what O'Neill teaches is true. You have to keep your losses small. And there is a point on every chart where every stock should be sold. None of these are lifetime marriages. These are dating relationships, and you have to do the technical analysis. You can't just rely on fundamental analysis or falling in love with a disruptive stock. It just does not work, and ARC shows us that. So I showed you the few on Survivor Island that I'm keeping an eye on, that if the market turns, and there's some reasons to get in, and we'll look at how that could happen in a minute, are ones to study. So things to look for, and some thoughts. The Fed talking heads are still ganging up on inflation, over and over. It's all about inflation, and until it comes down, that's our story, and we're sticking to it. They're not going to do anything. So we're back in the Volcker era, and they say we're not going to make the mistake that Volcker made, where he backed off on raising rates and inflation kind of reared its head again. So they're just hammering that. QT on the balance sheet, it is being implemented. They've kind of caught up. They started out slow, but they're at or exceeding the monthly goal on the balance sheet cuts. And of course, there's no end date for that. It's just a monthly cut. The war in Ukraine and Russia is continuing. That impacts things on a global scale. Officially, they're not calling it a recession yet by the talking heads, but the yield curve is inverted and we've got strong inflation and we've met their traditional definition of a recession, which was always good enough, but it's suddenly changed under this administration. So I think all of us feel like this is a coming. By the time they officially call it, the market may be putting in a bottom and we'll see some stocks setting up. So they're always behind on those things. And we're in a 13-month-old bear market. So, and still growing. So Ari pointed this out. All the MMTS are red. The window of opportunity is closed. IBD has slipped to yellow, but it sure feels like incorrection to me. Distribution days are piling up. Selling day count is crushing the buy day count. So it's a distribution dominant tape, as Mark Minervini talks about. New lows are outweighing new highs. Matt Caruso talks about this. If we're in a good uptrend, we should have more new highs than new lows in the market if we're trending up. So that's just confirming we're still trending down. And we see the index is working on potential fourth legs down, clearly on the NASDAQ and the S&P 500, and there's no rule that says a bear market can only have 3 legs down. O'Neill says they have at least 3 legs down. I think the 2000 bear, I think I counted 7 legs over that, 2.5 years, however long it went. So current market signs for me remain still a massive train wreck. It's just ugly out there. Have to be aware of that. The trading plan is not to. Stop doing that because nothing is working, nothing's making progress. Anything to do with smaller positions and maybe even take profits at a lowered profit goal of like 15%. But I don't see enough to start even trying that. So don't feed the bears. Violators are going to get murdered, and what doesn't kill you will make you stronger, except the bears. The bears will kill you. And so there are a lot of people that have found that out this year. So seriously, do not feed the bear. Don't feed the bear your fiscal capital. Do not feed the bear your mental capital. This one's probably more important than the first one. The M is just wrong for us right now. On the bright side, while we know this market's terrible right now, it's not a tricky sideways market. I mean, it is a little bit. Sideways is the hard one, but it seems like we're just back in bear status where we just have got to be patient. Still a clear downtrend. Trading plan is easy, just don't do it. Just wait till these things improve. Don't ask the wrong questions. Is this the bottom? Isn't the market too oversold? Aren't we due for a bounce? Why wouldn't the market bounce with everyone being so negative? Ask the right questions. Can I objectively identify a change in trend presenting a low risk opportunity to start getting back in? I'm sorry for the typo. So how does one do this? Got to study, understand the impactor, correct questions. Has there been a valid follow-through day? Maybe you look for a new one of those. As the window of opportunity opens, this one's key. I'm certainly going to believe it's appropriate to start wading back in when this happens, and the very last one also happens that we'll get to in just a minute. Has the Fed pivoted, or is the buying day count higher than the selling day count? That's still a no. Is there a trend of new highs exceeding new lows? That's still a no. Are the indexes constructive in light of where the moving average lines are? That's a no. We went through those. So we need at least one of these, and hopefully a couple of them would happen at a time. And do we see top-notch fundamental Canslim stocks set up in full and proper basis and breaking out? Are experienced investors, are they almost set up in full and proper basis? And do you have an early alternative entry per your rules to start a pilot or smaller size position? And then if you make progress, success begets success, and you can wade in further when all this happens and when there's a position and when things are working. So we always need to have an action plan. Sometimes it's just not a trading plan. So still a great time to study and read, do some courses, Matt Caruso, trader land. There's a lot of potential out there. Stay in touch with the market. Do your daily, your weekly analysis, your weekend routine. Do your chart work every weekend to prepare a watch list. If you did that this past weekend, you see oil and gas are showing strength again, clearly looking at the growth 250 in Market Smith. And then ought to be working on post analysis for 2022. What's the best trade? What's the worst trade? What's the overall mistake that was made? Too much trading, too aggressive trading, um, ignoring the Fed, ignoring the M. Find out what mistakes you made and do not keep making those in 2023. As I said earlier, the worse it gets to the downside, the better it's going to be to the upside. Jim Ropels talked about that. He did a recent podcast on IBD, well worth listening to his discussion and his reminders on what happens when you get sloppy and the need to be very strict in following the Canslim system. So EPS season will crank up soon, believe it or not, a couple weeks into January. And this is the one that runs for 3 months because they're reporting, this is the annual report, the 10K instead of the 10Q, which will have quarterly results as well as annual results in it. So that's sort of our buyable gap up hunting season if the M improves. So with regard to our monthly online classes, the next one will be Wednesday, January 18th. Register at the Stockyard Meetup site unless you signed up back for our October meeting, which we did not hold due to the medical situation in our family. So if you signed up for that one, I'll make sure you get the info to log in. You really have already paid. If you sign up twice by mistake, I'll send one of those back. So tuition is $12, includes live attendance, recording, slide deck, links to webinars, articles that we talk about during the meeting. If you're a first-time registrant, I send you a copy of the prior month's meeting, recording, slide deck, etc. So here's the agenda. We'll look at the M factor. We'll do many teaching segments on Canslim nuggets that have come up over the last month, 2 months from Bill O'Neill, IBD Live, podcasts, Matt Caruso, and other sources. We'll see if there's anything new in Market Smith we need to talk about. We'll go through some of our lists, which are listed there. We'll go over in more detail the short position in the group teaching portfolio, the reasons for that, the due diligence on that. Can look at any post analysis in the GTP and sort of for the year. And we can talk about the IPO market, which is still dead. So we'll see where it is by January 18th, but I doubt it really will have come back to life. So also our prior meetings or the recordings are available. Those are $15 each with the slide decks. If you don't have a set of written sell rules, really need to do that before 2023 starts. So I spent 3 months teaching that and covering it in great detail, as well as how to do a weekend routine in September of 2021, and then followed up on that in October. So there's some other ones there. If you're interested in those, you can email me. I'll send you the full list and ordering instructions. Meetup sites are the Greenville Eastside IBD Meetup and the Stockyard Meetup site. You can follow me on Twitter. And of course, the videos are on my YouTube page, which is where you are if you are watching this. So remember to like and subscribe. There's some other good things to learn on there as we head into a new year. So that's it. Again, I wish everybody hope you had a very Merry Christmas and also a Happy New Year as we go into the last 4 trading days of the year. And that's it. I'm out of here.